Hi, this is jeng, and today I'm gonna be talking about a quote that I hear probably 3 or 4 times a day, and it is, "I want to buy my own deal." And I hear this from doctors, accountants, lawyers, people who just sold their business. They want to buy their own deal. So today I'm going to be talking about how to analyze a multifamily deal. I'm just going to take a 60 unit deal, which is a good size for most people to start. I would say 60 to 100 units is a good size for someone to come in, buy their own deal, and have it professionally managed. Right. So what does it take? How are you going to look at the deal, analyze the deal, understand it, and underwrite it? Because it is different than your standard 200 unit deal. So here in this, we're going to be focused exclusively on this sort of individual uh, type of investor, right? So this individual, they're going to be signing on the loan. They're going to have full control of the asset management. They're going to make all the decisions, what the distributions are going to be, what the cash flow is going to be, who's going to be the property management. They're going to have to go out, find the deal, negotiate with the broker. They obviously don't receive any acquisition fee. It's their own money. They're going to get all the advantages, and they're going to be able to 1031 this deal, right? So if they buy a deal and it's 50 units, and then they do well, and they move it up to 100, 150 units from there. So to the individual, you already have the equity, and your job now is to go out and find deals. And so if I handed you a $5 million deal, could you close it in 60 days by yourself? And what that encompasses is typically you putting 25% down, let's say 1.25 million, and then I provide the debt, let's say 3.75 million in debt, and you close on the $5 million deal. Now, how do you qualify from a loan perspective? So your net worth needs to be greater than the loan amount. So your net worth, including your personal residence, needs to be greater than 3.75 million, which is a loan. And then your post-close liquidity. So this is where people get hung up, typically on buying a deal by themselves. Is they have the 1.25 million in equity. Great, you put that down. Now the lender wants you to have 10% of the loan amount in cash or marketable securities. So 375,000 in cash or marketable securities, non-retirement, after you put that down payment down. And so do you have that? And then the third thing is prior multifamily experience. Do you have any multifamily experience? And they've been flexible with that in the past. They might lower your leverage. They want you to have third-party property management. But we're going to discuss that in a little bit more detail. So looking back on this, where your focus should be is finding new deals. And so we're going to talk about a case study. I just I took a blend of, let's say, the last 6 months of deals out there that have been anywhere from 50 to 100 units, and just created this, 60 unit deal in DFW. Let's just say it's a Class B deal, 50% ones, 50% two bedrooms. In place rent is, $825, and you want to take it to $900. It's 95% occupied, individual AC, pitch roof. And the listing broker is saying, look, the whisper price on this deal is $5 million. So if you can get me $5 million, you're in the running. So let's start analyzing the deal. And so what I did was I made went back to just the basic model that we have here in Excel. And it really just has 4 inputs, right? So your basic purchase price, rehab, loan data, your rent roll, your expenses, and then your inputs for projections. So I went ahead and filled this out, and I'm going to use some slides to go through how I underwrote it. So right now I plugged in a little bit lower price, 4.75, rehab of about 250, which is about 4,000 a door, 70% of in terms of the loan amount. And so what I did was I had a lender underwrite the deal, and you can see right here, they essentially provide you a term sheet, right? And so they underwrite the deal. They say, all right, what can this deal in terms of cash flow sustain? And so right now it's about 3.5, and the rate's about 4%, right? So I plugged that in. We got 1 year of interest only, and then 30-year AM after that. In terms of closing costs, it's going to be higher for smaller deals, right? So a lot of the things, like your loan origination fee is still 1%, but your third-party reports, your engineering, environmental, appraisal, that's going to be, close to 20,000, 10 to 20,000. Attorney fees are going to be another 20,000. Title costs, there's not really an acquisition fee. So right in that, I just put in 3% for this particular deal. Working capital, so this is going to be to do that rehab. or if, something goes out on the property that is larger, you're going to need that working capital. So we put that in at 2%. And then the reserves at close. So right now, loans under in that sort of $1 to $6 million range. Right now, Freddie Mac is saying I need 12 months of P&I on the deal, and then if it's under 6 million, Fannie is saying 18 months P&I, 12 months taxes, 12 months insurance, 12 months replacement reserves. So on this particular deal, I stuck with Freddie SBL. So when you go into a model, the reserves at close, this 200,000 is basically just your principal and interest, right, for the year. And so they're going to have you put that up at close at 200,000. Let's see. So we went through the reserves. Now let's talk about reversion cap rate, right? So I put in a chart here on reversion cap rate by market. And, in the preferred markets, that cap rate is about 5%, right? And then I would say Dallas, Fort Worth is sort of probably in that primary market, right? So about 5.5 to 6%. And, as you go out further, secondary, tertiary markets, it increases. And then it's the same thing with class, right? So A, B, and C, but that has come in as well. So depending on the market that you're investing in, that cap rate is going to be there. Cost of sale on smaller deals, it's usually about 2%. That's going to be a listing broker. It's going to be your title cost. No sponsor comp, no acquisition fee, no asset management fee, because it's your own deal. Unit mix, right? So, this one I kept pretty simple, 30 units at 1 beds, 30 units at 2 beds. And here's just an example that I pulled out from a market report. And let's say your existing, units are 930, that you're getting $930, and then you see rents, going up to, let's say, 975, right? So this list kept going up. But I wanted to show you that, your pro forma rent's at 950, and then, your current rent at 1,025, and then 1,100 is our pro forma. So the chart shows 1 bedroom, but you can also pull the rents for the 2 bedrooms, do the same thing on pro forma rent. All right, here's where it's a little different for a smaller deal, right? And when you underwrite it. And so let's just start with management fee. So management fee, if it's 200 units or 150 units, usually it's about 3%, maybe 3.5%. But once you get down into that 50 to 100 units, I modeled 5%. I looked at some deals in the sort of DFW surrounding area and saw sort of based on the units, what their management fee was, based on the financials I was seeing. And, you can see it's anywhere from 3 up to 5.5%. So I plugged in 5 just to be safe on this deal. G&A, right now it's about 400 a unit. It's going to just be like your administrative costs just to run, let's say, the leasing office, professional fees to do tax returns, things like that, eviction fees, things like that. So G&A, I put in at about 25,000. Payroll. So this is where, on smaller deals, this is a big one. So payroll, as you can see here, these range from anywhere from, 100 units or 150 units all the way down to 60 units or 50 units. And it's all over the board in terms of payroll, right? So some people are running pretty lean shops with just like, 1 person in, 1 person outside. And then other people just have part-time people. So I plugged in 70,000. So that's 35,000 for maybe a leasing agent, property manager, and 35,000 for someone outside, on the repairs and maintenance. Utilities, that's really going to be trailing 12. So looking at utility bills, same with water and sewer. Repairs and maintenance, probably about 600 to 700 a door works. Insurance is going to be a little bit higher, so I'd probably plug 500 a unit in there, as long as there's no previous claims on the property. Real estate taxes, same thing, 90% purchase price times current tax rate. And replacement reserves, about 300 a door, works for these smaller deals as well. So looking at expenses, management fee is a big one, payroll is a big one, in terms of a smaller deal versus, a larger 200 unit deal. Projections are about the same. I was a little bit more conservative on the rent growth. I started at 0% in year 2, but then grew it out 2% thereafter. You plug in your other income on the projections from there. So let's go back. So once you plug in all your projections, box 1 was the purchase price, loan information, your rent roll, your expenses, your projections. Now we're going to really get into the returns, right? So what your returns are as the owner, and then sort of looking at the outputs to make sure it all makes sense. So let's go through it. So the returns, right? So total return was about 70%, IRR 13%, average cash on cash 9.4%, which is pretty good. The initial investment is a lot higher than we originally thought, right? So let's go in. So the initial investment, the way we calculate it is here, right? So you got your loan amount 3.5 million, you got your equity of 1.9 million. So you needed 5.4 million to close this loan. And that 5.4 was made up of the purchase price, your rehab, your closing costs, your working capital, and the reserves. And so that is one thing that we didn't take into account when we looked at the beginning of the show, in terms of the down payment, right? So right now, these reserves are making you bring an additional 200,000 to the table. And then when you close these loans, you also need, the extra rehab, your closing costs, and your working capital. And so let's go through the property cash outflows. Like, this is pretty much the same. The only thing that is a little different that I would be watching is probably your expense ratio. That's typically 50 to 55%. It might even be 60% on some of these smaller deals. So watch your expense ratio. And then here in year two, so after about 12 months, I'm projecting you're going to get that reserve back. So that's going to come to you in the form of cash. And so we'll see that in the cash flows in the next couple slides. So in terms of net sales proceeds, right? So you're going to be growing the NOI of this property, right? So you start at, let's say 300,000, 315,000, and now you're going up to 370,000, right? And the way you're growing that is through rents. You're bringing it up to market. You're decreasing the vacancy. So now it's worth 371,000 on the NOI, and you're capping that, right? So we use the 6.5% cap rate, and that's getting to 5.7 million, right? So you're buying it for, let's say 4.75, and you're selling it for 5.7. So you're essentially getting close to 2.3 in net proceeds, right? So you invested your amount at the beginning, your initial investment, you've got cash flow along the way. And then at the end, this is just what you're getting at the sale of the property. And so let's flip over to the next slide. And so you see you have your cash flow from the property. And, this is going to be, 9%. This one is a little bit inflated in year two because of the reserves coming back. And then the deal starts amortizing. So you have 128,000, 140,000. So you're receiving that cash along the way. And then you're also getting all your money back plus a lot more in terms of proceeds. So your total cash that you receive across the entire deal here is these two numbers. So minus your initial investment. And so here's your stream of income. This is probably the simplest way to look at it. So you put in 1.9 million. You get 173, 315, 128, 141, and 2.5 at the very end. And so that is what is driving your return, your IRR over the deal. In this one, there's no sponsor, so it's pretty straightforward on this analysis. No sponsorship data. This is just the loan data, P&I data. So we did 1 year of interest only, and essentially you're paying down that principal every year by about 60,000. And in sources and uses, we went through this on the other chart, but your rehab, closing costs, working capital, and then your reserves at close are going to build in, not on top of your purchase price and rehab that you're going to need. So this is your base case returns, right? So 70% total return, 13% IRR, 5 years cash on cash. 5-year average cash on cash was about 9.4%. So overall, a pretty good deal. And now we're going to look at some different scenarios that could impact your overall returns. So, the whisper price was $5 million, right? And so in order to win the deal, you might have to go up to 5 million, right? So that's going to increase your initial investment to 2 million. The loan is going to help a little bit with that. If they're able to do more in terms of loan amount, your return is going to go from 70% down to 50%, which you have to be comfortable with. And then your cash on cash is going to go down. But if you're able to buy it for 4.5, less initial investment, higher return. So that gives you a good scenario analysis in terms of pricing when you're talking with a broker on what you can do going forward. In terms of interest reserves, it's probably hurting your return by about 8%, 9% here, because you're having to put up an additional 200,000 and then you get it back in year 2. And so this is taking your return from 70% all the way down to 68%, which is what our base case was initially. Reversion cap rate. So, we use 6.5%. That's, what people are, I would say, let's say a B deal right now in Dallas is, let's say 575 to 6, right? So in our base case, we added 50 basis points in 5 years. But if interest rates stay really low and there could be, upside on the cap rate in terms of it doesn't move. So if you buy it at a 6 and it stays at a 6, your return could be up to 92% right here. But if it does expand upward, people see a lot more risk in the space for whatever reason, then it could go down to 48%. So you can see this is a big swing in that reversion cap rate. And so obviously, the more conservative you want to be here, the less you can pay, or as long as you're willing to accept the lower return. Leverage, we use base case of 70%, which is pretty conservative. If you went even more conservative, you put more equity in the deal, 2.1 million. Your return would be a little bit lower, but it would be a safer deal. And then in terms of 75% loan to cost, less equity in the deal to get a slightly higher return. Interest rate, we modeled for 3.5% to 4.5%. It was actually didn't make a material impact. I was a little confused on why the initial investment was changing, but that was actually because when you go in here and you change the interest rate, it actually changes your P&I payment. And that is what was driving that reserve. So I thought that was a little bit interesting. And then the rent growth, I use 0%. But if you crank it up to 2% throughout, by year 2, like let's say we're opening up quicker and you start going, in terms of rental growth, then 82%. And if it's 1%, it's 52% drop. So now, after all this analysis, you're saying, all right, look, I want to buy the deal for 4.75, right? Works for me. Get that 70% total return. And then, so what's it going to take for me to win that deal? So as you can see, you now need that 1.3 million in equity. That's your initial investment. You need that $3.5 million in debt. So the qualifications for the loan, you need 3.5 million net worth, including your personal residence. And then you're going to need 350,000 in cash or marketable securities after that down payment of 1.93. So the deal's changed a little bit compared to what we saw before. So that is just going through a 60-unit deal, buying it on your own. My background, born and raised in Texas and lived in DFW since 2006. I've been a loan underwriter for G Capital. I've been a loan originator as a mortgage broker for the last 5 years, underwriting or originating close to 800 million in loans, and then also invested in close to 6,000 units across 21 properties in DFW, Austin, and San Antonio. So if you have any questions, you want to receive, let's say, the underwriting model, subscribe to the YouTube channel, like and share this video, go to txmultifamily.com, join the email list, and then set up some time to talk with me. We'll go through your personal financial statement and sort of talking about buying, selling, refinancing your next multifamily property. Thanks, guys.